Carol?
In your 1999 article in Fortune magazine, you stated your belief that after-tax corporate profits were unlikely to hold much above 6% for any sustained period, due not only to competition but also to public policy. You stated in the article, if corporate investors in aggregate are going to eat an ever-growing portion of the economic pie, some other group will have to settle for a smaller portion. That would justifiably raise political problems. Since 2008, after-tax corporate profits have been 8 to 10% of GDP. Do you believe that is a permanent shift in the U.S. economy? And of course, we have to think about the latest tax bill. Or will corporate profits revert back to the 4% to 6% of GDP range that was normal in the 20th century?
Well, it's been an interesting development during that period. It goes back a little bit before that period, but you now have the four largest companies by market value in the United States, a $30 trillion market. You have four companies that essentially don't need any net tangible assets. And if you go back many years, I mean, if you looked at the largest companies, Carol used to put out the Fortune 500 list, and it would be AT&T or General Motors, and it was companies that, ExxonMobil, it was companies that just required lots of capital in order to produce earnings. So American industry has gotten incredibly more profitable in aggregate in the last 20 or 30 years. You look at the return on the S&P 500, the earnings as a percent of net tangible assets, and the rest is just, if you buy a company that has $1 million worth of net worth and you pay $1 billion for it, it still only had the $1 million of net worth. I mean, you just paid more for it. So the basic profitability of the company is huge, even though your investment may be at a significantly higher price. And so that what has happened is that I think if you look at the earnings on tangible net worth of the S&P 500 and compare it to 20 years ago, it is amazing. And that is really due to the fact that this has become somewhat, you could call it an asset-light economy. And those four companies that earn 10% of the they comprise close to 10% of the market value of the entire publicly traded corporate America. They don't take any money, basically, and that is a changing world, and they will earn even more money with the tax rate going down, and I don't think people have quite processed all that information in terms of what has gone on in the market. Carnegie built a steel mill and then he paid it off, or he borrowed a little money and then he built another steel mill and all of that sort of thing. But it was enormously capital intensive, and one industry after another. AT&T was enormously capital intensive, and now the money is in the asset light. I mean, huge money is in the not only asset light business but the negative asset. IBM it has no tangible. There's a net minus tangible net worth. There's nothing wrong with that. It's terrific, but it is not the world we lived in 30 years ago. And in that sense, I didn't see that coming in 1999 when I wrote whatever I wrote there. It hasn't changed the profitability of the asset-heavy companies particularly. I mean, it isn't like oil. If you take the 5 most capital-intensive industries in the 90s, I don't think you'll find that their earnings on tangible assets have increased a lot. But you will find that this group has moved in that really doesn't. They don't need any net tangible assets at all, or they need very minor amounts. Charlie?
There's also a lot of financial engineering that's raised leverage, even in the capital-intense businesses. And, while Warren may have predicted a little wrong when he wrote that very scholarly article. He didn't invest wrong. And so it just shows it's hard to make these economic predictions.
Okay, John.
You are very right on that one, Warren.
Yeah, actually, the performance of the stock market since then has been pretty accurate.
Yes, but that's true.
Yeah, being right for the wrong reason or something, or wrong for the right reason.